All right, good morning. Welcome to today's Pensions and Lifetime Savings Association webinar, Gold, the Missing Element for Pension Returns, which we are holding together with our education partner, the World Gold Council. My name is Rachel Pine, and I look after content for the PLSA's conferences and training. It's exciting to have a presentation which focuses so closely on a topic of immediate importance to our audience. The ongoing market volatility caused by the COVID-19 pandemic has had some investors considering a change to their allocation. And of course, gold has long been known as a safe haven asset. The World Gold Council is a membership organization comprising the gold miners who represent more than 50% of listed global mine supply. Their mandate is to educate and share market knowledge, and they've found that they are spending increasing amounts of time answering questions from pension funds about gold. As a matter of fact, at our investment conference in Edinburgh this past March, the PLSA and the World Gold Council launched a Made Simple guide called Gold Investment Made Simple. I will be sending that to you in the chat box toward the end of today's webinar. We're joined today by John Reade, Managing Director and Chief Market Strategist of the World Gold Council. With more than 30 years of experience in the gold industry and related fields, John has been a gold strategist for hedge funds and investment banks and has actually worked down mines and on gold mining projects. John is one of the world's foremost authorities on gold investment and leads the global dialogue by engaging with fund managers and investors on gold. Joining John is Jaspar Crawley, who is the Council's Director of Institutional Investment. Jaspar builds relationships with pensions, fund managers, and other investors. He's a former precious metal sales trader at several city firms. I don't think we could be in a safer pair of hands for today's conversation. John and Jaspar are going to talk about gold's impact on portfolios and address the key barriers to investment. They'll also talk about the ESG implications of investing in gold, as well as how it can impact climate change. And we've built in lots of time for your questions. We're going to have a few polls during the webinar. I'd actually like to start with one right now. May we see the first poll, please? So, not counting what I've just said, how familiar are you with the World Gold Council? All right, so a bit of a mixed bag. So it seems most people have heard of the World Gold Council. Excellent. Well, we've got an audience full of people from DB, DC, local government, and master trust schemes, and I'm sure your presentation has something for everyone. John, I'm going to leave you and Jaspar to it now, and I'll be back at the end to help with questions.
Fantastic. Interesting poll. Well, I would say one thing, 16% of the respondents won't be able to say that again, because you will have heard of the World Gold Council after this moment, I guess. Well, thank you very much for voting there. We'll do a few more of these as we go through. I think I just click close and it disappears. I apologize for my slight ineptitude here. We don't use Zoom at work. I think someone needs to share the screen with me so that I can drive it as well. There we go. Excellent. So, my name is John Reade. I'm the Chief Market Strategist at the World Gold Council, as you have heard. I'm going to give an update on the gold market. We're going to talk a little bit about the investment case for gold from a UK perspective. We'll talk a little bit about ESG as well, which I think is increasingly important in the world, and then we'll head to Q&A. As we heard from Rachel in the introduction, the World Gold Council is a market development organization. We're owned by mining companies around the world. You'll see some Chinese names, some North American names, some South African names on there, and Australian as well. And our job is to develop the gold market, both on the consumer side, so we do some work with jewelry and other aspects of consumer demand, but I spend most of my time talking to investors about gold. We try and develop the market in a number of ways. The areas I'm particularly involved with are around data analytics, research, and market knowledge. So we believe that one of the barriers for investors actually doing more in gold is that they don't have enough information. They may have some preconceived ideas about it as well. So we produce a lot of data, a lot of research to try and shed light on gold, and particularly as an investment asset. We work on the policy side as well, so working with countries where, for example, they may have a high tax rate on gold, or they may ban the imports of gold. So we try and develop free market policies for gold trading and access to the market. And where necessary, we'll get involved with market infrastructure. So, for example, we're working on a new gold exchange in India, which, despite being the second largest country for gold consumption in the world, doesn't really have one at the moment. So we do lots of different things. So I'll start out with a short market update. And this is just a couple of slides saying what's going on at the moment. I took these slides from our document, Gold Demand Trends, which we released last week. We had a presentation, there's a webinar which goes over this in much more detail, all of which is available on our website for free, which I'll talk about at the end. So looking at how the price of gold has performed this year, it's been on an upward track generally, and not just in US dollar terms, but in all currencies. You can see how gold started to increase perhaps a little more rapidly as the concerns about the coronavirus and its impact on the global economy started to take off towards the end of February and the beginning of March. And then you'll see gold fell along with most other risk assets as those concerns turned to fears. We then saw gold bounce back pretty strongly, and it has been performing well since then, and is up somewhere in the region of 11–12%, depending on the currency that you're looking at year to date. So looking at demand in the first quarter, we saw clear signs of a shift in the gold market, weak consumer demand, and strong investment demand, particularly into gold-backed exchange-traded funds. These funds, and we track about 80 of them around the world, are listed in most major markets. The holdings are dominated by North American and European investors, and indeed it was those investors that stepped up their purchases in the first quarter. We also saw strong demand for investment coins and bars in the sorry about that, something glitched on my PC. Let me go back to that. Right. No. Sorry about this. There we go. Sorry. We also saw strong demand for investment coins and bars in Western markets, although in developing markets, particularly India and China, we saw lower bar and coin demand, and particularly in developing markets, jewelry demand was hit particularly hard. So if we look at the two bar charts there, you can see how there has been a big shift in the constituents of demand in the first quarter, with Western investment demand very strong, consumer demand for jewelry somewhat weak. I'm going to talk shortly about the strategic case for gold, because I think that, or we believe that there is a case for investing in gold in your portfolio, in most portfolios pretty much all of the time. And we think that the rationale for investing in gold is not well understood. Before I do, however, I'd like to ask another question, please. So one of the things that we've found from polling of investors is a belief that gold delivers poor returns over the longer term. Do you agree with that statement? And you've got 5 choices there, from strongly agree to slightly agree to no view to slightly disagree to strongly disagree. So I'll give you a few seconds to consider this. I think a lot of people believe that gold performs well during crises and maybe during periods of high inflation, but that it's an asset that you should own only during those periods. So do you agree? Okay, that's disappeared off here. Now that's interesting. I think that I can see that we have slightly tough house here, although the biggest plurality of responses actually comes from the no view, which I think is good from my perspective because it shows that I do have work to do in making the case for gold. I would hope that with what we speak of today, we'll be able to at least reduce the no view. People may not necessarily agree with what I'm going to say, but at least they'll have information to make that view. Excellent, thank you very much. That's gone. Right, so back to the strategic case for gold. You can make the strategic case for gold on basically for 5 points. So returns, diversification, portfolio impact, liquidity, and I'll touch a little bit on the outlook at the very end of the presentation. Firstly, in returns, and I would say that these returns are shown in sterling. We've run this exercise in many currencies, US dollars obviously, but lots of other currencies as well. For the work that we've been doing with the PLSA, we've had a look at returns in sterling terms. And as you can see, we've shown gold and we've compared it to investments in cash, a UK bond aggregate, UK equities, all world excluding UK equities, emerging market stocks, and commodities as well. And what you can see is whether you look over 20 years, 10 years, or over the last 5 years, gold has produced returns which are, broadly speaking, in line with, better than, or slightly worse than, the returns that you get from investing in these other assets. And average returns over the last 20 years of around nearly 11% stack up particularly well against other assets that we've considered here. So it's not just an asset that performs well during periods of inflation or during crises. It's an asset which has performed well over the last 5, 10, and 20 years. The other factor about gold, which is really important for portfolios, is the fact that it offers genuine diversification. If we look at a correlation of weekly returns between gold and UK equities, and we've just taken the FTSE here, it's generally speaking uncorrelated most of the time. What we've done though is we've broken down this correlation into various regimes. So we've looked at when the FTSE is up strongly, when it's not particularly doing very much, when those weekly returns are between -2 and +2 standard deviations, and then when the FTSE has fallen by more than 2 standard deviations on a week. What you can see there is gold's generally uncorrelated, except when the UK equities are falling fast. And when the UK equities fall fast, that correlation is strongly negative, which is what you want. You want to be negatively correlated to things that are falling quickly when they're falling quickly. So this dramatic increase in the correlation, or the negative correlation between gold and UK equities, is quite unusual. We've looked at lots of different correlations between asset classes to see whether there are any other assets which give you this sort of benefit during stress periods. And with the exception of silver, sort of a rather lame cousin of gold and less liquid and not really suitable for institutional investment, we haven't been able to find anything. And indeed, we're showing here actually general commodities to show that those commodities don't suffer the same inversion in its or exacerbation in the negative correlation. And that's generally because most commodities are growth assets and sensitive to industrial production. Putting things together, that combination of returns and diversification, particularly when you need it, results in an improvement to the risk-adjusted returns of a portfolio containing gold. So what we've done is we've taken an average pension fund portfolio over the last 20 years and shown its performance in risk-adjusted returns. And that's the left-hand side of this line. Then we've added 5% gold, 7.5% gold, 12.5% gold, and proportionally reduced the holdings of everything else. And you can see that the risk-adjusted returns of that portfolio have improved in each case. And generally speaking, the more gold we've added, the better the risk-adjusted return. We've also looked using an optimization tool about how much gold should go into portfolios. I'm not going to go into this in a tremendous amount of detail, but to suggest, and just look at the dark green bar there and the gold bar, that generally speaking, the more equities that you have in a portfolio, the higher the optimal allocation to gold, which makes sense if you think about the diversification slide that I showed before. Gold is a particularly good diversifier of equity holdings, whether they're UK, US, global. It's a less good diversifier of bond holdings. So the higher the risky components in your portfolio in equities, the greater the ideal asset allocation to gold. I'm going to ask another question now. If we could go to that one, please. So what is the current gold allocation or allocation recommendation of your institutional organization? None, 2% or below, between 2 and 4%, 4 to 6%, or above 6%. Now, it's a tricky question, but I hope we get some interesting answers out of this.
Yeah, and if you're a trustee, I'd say, you know, what does your consultant recommend?
Thank you, Jaspar. Interesting to see that we actually have some allocations to gold within the answers here, which I'm really interested to see. The fact that 81% had no gold allocation is not a surprise to us. It's in line with what we have found from other polls and conversations that we've had. And I think I'll take this back and show it to my boss as an example of we have work to do, which we do know. Okay, excellent. Let's close that one off. Getting back to the presentation. The final thing I'd like to make on the case for gold for strategic investors is one of liquidity. We often hear people concerned about liquidity in portfolios, particularly as we've seen an increase in alternative asset investments. People chasing yield in return for lockups and illiquid portfolios. Gold is one of the more liquid assets classes out there. And what we've shown here is turnover a day in $1 billion sterling compared to, for example, FTSE 100 stocks, UK gilts. And really, it's only when you start to come to the very large liquid government debt markets that you do see that gold is disfavored. So we've just looked at 1 to 3 year treasuries here. If you look at the whole curve, the US bond market is more liquid than gold, as is JGBs as well. So one of the questions that we often get is gold liquid enough to invest in? And the answers that we can show based on volumes from the over-the-counter market and the commodity futures markets around the world is yes, it certainly is. I've got another polling question now before I touch on an important topic for the gold market. ESG factors are now decisive in shaping your asset selection. Do you agree with that statement? Do you strongly agree, slightly agree, have no view, disagree, or strongly disagree? Certainly a topic that I've found has become really popular within presentations and conferences that I used to attend. Everybody seems to have an ESG angle nowadays. Give it a few more seconds for you to answer. So do you agree with the following statement? ESG factors are now decisive in shaping your asset selection. Okay, let's see what the answers have. Interesting. The thing that interests me the most actually is that 12% of the respondents actually disagree a little or a lot. I'm not surprised to see that that a lot of people would agree or strongly agree that ESG is an important factor. Okay, very interesting. Thank you. Okay, moving on. Why do I bring that up? There we go. Because we've certainly found that ESG factors have become crucial for us to be able to engage with some investors. Now, it does vary. If we're speaking to European investors, particularly continental European investors, then we find that understanding the ESG implications of investing in gold is absolutely crucial. If we speak to US investors, it's much more mixed. And the UK, in my experience, is rapidly going very close towards continental Europe if it isn't even there already. So as an organization that is owned by gold mining companies, we've done two things. The first of all is, in conjunction with our members and on their behalf, is that we've developed a series of responsible gold mining principles. This doesn't affect gold ownership per se, it's more to do with the way that gold is mined. Now, you can argue that if the gold exists already and has been mined and processed into bars of gold, this is less important. But even so, a lot of investors care a lot about the source originally of that gold and making sure that it's been mined in a responsible way. So it's an ESG framework which defines gold mining. It targets these areas that you can see on the right. It's developed with strong input from civil society, governments, supply chain participants, a lot of conversations with NGOs, and the conformance with it needs full disclosure and independent assurance. Now, our members have signed up to this and are implementing it with an implication that it'll be in place fully over the next 3 years. It's not that they're not doing it already, it's that bit about independent assurance, which is taking time to get in place, to making sure that you're filling the surveys in and able to document everything that you do. I think it definitely represents the commitment of the world's leading gold mining companies, and it's also open to gold mining companies that aren't members of the World Gold Council. We're trying to lead on behalf of the industry, not just our members. The second thing that we've done is we've done a couple of pieces of work looking at gold and climate change. And what we're trying to show there is the extent to which mining gold, number one, and number two, owning gold after it has been mined, contributes to climate change. The two things I'd say is mining gold, obviously, at the moment, does contribute to climate change emissions. But there are practical and cost-effective ways to decarbonize mine production and move to net zero by 2050, and faster in some cases. So, like many other industries, the gold mining industry is looking to become net zero by 2050, mainly through the replacement of diesel and oil generation of power and powering of vehicles to replace them with electricity that can be generated from renewable resources. Once the gold's mined, though, it has a very low downstream carbon footprint. You incur all of the, or 98%, I think it is, of the greenhouse gas emissions in mining and refining gold. Once it's in that physical bar, it doesn't generate much in the way of greenhouse gas emissions. And even if you turn it into jewelry and then remelt it down, that's where the 2% comes from. It's extremely small. So in some respects, we believe that by putting gold into a portfolio and comparing its ongoing greenhouse gas emissions compared to, say, owning equities or even government bonds, arguably, then there is an argument, which we're beginning to make, that gold can be considered to be a climate risk mitigation asset. So what do we think for gold from here? Well, we saw gold fall as the full extent of the coronavirus crisis struck. It's nothing we haven't seen before. Often when you have a deleveraging, a disinvestment phase, when markets suddenly go into panic mode, people sell assets to raise liquidity or reduce leverage. And gold, because it is a liquid asset, sees those sorts of flows. But it's turned around and bounced quite strongly after the monetary and fiscal response to the crisis. If we look at Q1 demand numbers, we've had good physical investment and weak consumer demand. That weak consumer demand will improve, but probably won't be a strong year for jewelry and industrial demand for gold. There's been some signs of dislocation in the gold market, as many markets have been affected by the logistical challenges and the near shutdown of the airline industry. But it's not affected liquidity enough to stand in the way of to affect the liquidity of the market materially. We certainly think that the current environment, which has seen strong Western investment in gold, is likely to continue. Gold typically attracts a lot of investor interest when economies tip into a recession, and we're certainly getting that at the moment. I think the second thing is, as well, is that gold often attracts large-scale investment when investors worry about the potential for the impact of policies such as quantitative easing or big expansions in fiscal deficits. And we're certainly going to see that this year and probably over the medium term. Consumer demand, however, will remain weak. The biggest driver of consumer demand, which is principally jewelry, is incomes. And the other thing, of course, is the price. And incomes and wealth have been hit around the world by the coronavirus crisis, whereas price is high, particularly in some local currencies. So all the work we do is available on our website, which is simply gold.org, and we have a section on there for all the research and data called Gold Hub, which falls under my team. I'd recommend you go there, have a look around. If you're interested, sign up to it. It just requires registration. My colleague Jaspar, who will help me with the Q&A, as was introduced, is a Director of Institutional Investments. His email address is on here. Mine is simply my first name dot last name at gold.org. We're very easy to find as an organization if we know our names. But similarly, social media, Twitter, LinkedIn, we are very active. And as you can see, the work from home World Gold Council Strategy Office, from where I'm sitting today, is well kitted out and continues to study the gold market incessantly. So with that, the obligatory disclaimer, I'd like to hand back to Rachel, who will handle the Q&A.
Great. Well, thank you very much, John and Jaspar. On to questions. We had some that were sent in before the webinar, which I'm going to add into the mix.
Yeah.
We've had a couple of questions already about yield or income from gold. Someone said, there's no income with gold. How do those in favor respond? And then of investing respond. And then someone also said, is there a gold lending market? So if so, could you create a yield?
Well, the answer to those is linked, and yes, that's correct. There is gold generally doesn't generate an interest rate. So if you own gold and you have it either in your own possession or stored at a bank at a nominal cost, typically less than 5 basis points, depending on how much you've got, you're not going to earn a yield on it. And the way I would say that is you don't have credit risk. And if you don't have credit risk, then why should you be compensated with a yield? Everything that you do get a yield on, you're taking credit risk in one form or another. Obviously, there are two components of returns for assets. One is the yield, in which case normally in gold is zero, but the other, of course, is capital appreciation. And as we've shown over the last 5, 10, 20, and also back to 1971 when basically the world came off the dollar-linked gold standard, gold has produced total returns through capital appreciation on average that match other assets. Is there a gold lending market? Yes, there is. The interest rate on it is generally low, unless you're prepared to risk, but to lend to riskier institutions. So you can, through lending, take on credit risk by lending gold and earn probably up to 100, maybe 150 basis points, depending on tenor and credit risk. But that's not really a component that most people think about when they're investing in gold.
All right, really interesting. What about trading and transaction costs? How can people get into this? What are the costs?
Well, there's a number of different ways to invest in gold. In general, most institutional investors buy gold in one of three ways. The first way is perhaps more unusual in the UK, but we have certainly seen it from institutions in North America, is to buy gold via the futures market, COMEX, deep and liquid. That's probably less common outside of the United States because often investors tend not to actually invest in the futures market. It's probably more cost effective as well to invest in the over-the-counter market. So in other words, bilaterally with a bank that either has or can arrange gold transactions for you. Bid-ask spreads are pretty tight, around about $1. Gold's trading about $1,700 at the moment. So bid-ask spread's quite tight. Storage costs, as I mentioned before, in institutional size, then it varies, but depending on the size you've got, 5 basis points, maybe 10 basis points. So it is a market that can be accessed that way. The most popular way, or the area that's grown the fastest in the last 15 years, is exchange-traded funds. Exchange-traded funds tend to be slightly more expensive in terms of holding costs, with expense ratios in the order of 20 to 50, I think, at the outside basis points. But it gives you the opportunity to trade them on stock exchanges and hold them perhaps more conventionally than you would with an OTC account. Certainly, retail investors tend to favor ETFs because of their simplicity. Often we see institutional investors who start off in gold, starting in the ETF market, and then when they become more comfortable about it, migrating over to the allocated over-the-counter gold market because it's cheaper and are more confident about understanding it from there. So lots of different methods. You can also buy gold shares as well, but we don't really talk about those because yes, gold shares are exposed to the price of gold, but they also have lots of other operating and political risks in there as well. So there certainly is an option, and many investors, many equity investors will have some gold shares in their portfolio, but it's not quite the same as owning physical gold.
Right, so a couple of questions actually about the ways to own gold. One person's asked, Would you ever recommend physical allocation rather than ETFs and mining stocks? And with regard to ETFs, how can you make sure that when you invest in them, you own the underlying asset in case of an insolvency?
Okay, two linked questions. I think I've answered the first one to a certain extent. I think if you're going to hold gold in reasonable size for the long term, so an institutional investor that doesn't intend to trade in and out of it frequently, I think an allocated gold held with a with a bank is a more cost-effective way of holding it in the long term. You don't have quite as much flexibility as you do by holding an ETF, but it is cheaper in general. In terms of when you buy an ETF, do you own the underlying? Well, not quite. You own an asset issued by a trust. The only asset of that trust is gold. So you own an instrument issued by a trust. The only asset of that trust is gold. So it is allocated gold, owned by the trust. In the event of an insolvency of the bank where the gold is being held, the trust has an allocated account, so it is outside of the bankruptcy or the insolvency provisions. It's like the trust has it in a safety deposit box, so it gets it back, although probably after a few months of the usual stuff that goes on during insolvency. But no, you do own it. Now, you should be careful if you're thinking about exchange traded things to make sure that you are buying an instrument that is backed by gold and not by gold derivatives. There are a number of exchange traded products out there which give you exposure to gold futures. When you're running gold futures, you don't have the same protections, and you probably actually incur more costs as well because of the cost of those rolling futures as well. So we get a lot of questions, particularly with what's happened in the crude oil market. Well, to be precise, the crude oil futures market, when you saw WTI futures trading negative recently, and whether that could be anything that could affect an ETF. And the answer is, as long as the ETF is on physical gold and not on a gold future, then you don't have the same sort of risks as you do regarding roll yield and futures pricing.
Right. Okay. So you mentioned in your presentation that in March there was this gold price correction. Can you explain a little bit more about why it happened and just more broadly the risks of gold investment? Sure.
Gold was owned by lots of different classes of investors or categories of investors, as it always is. And some of those investors are leveraged investors. When typically you have a sudden stop of an economy or effectively a financial crisis materializing, the first thing that leveraged investors do is take down risk. They reduce their longs, their shorts, their assets which are supposed to be benefiting from economic growth, and at the same time they're cutting their assets which are supposed to hedge them as well. So gold got sold, equities got sold, credit got sold, even government bonds got sold. So we saw a big move in government bond yields as well. Now those are supposed to be the safe assets which are aren't supposed to be hedges to your portfolio as well. So everything got sold at that point. And that sort of deleveraging or degrossing event we've seen before in financial crises, when something suddenly happens to change risk appetite amongst a whole range of investors. We've seen all assets get sold, and gold is amongst them. In terms of the risks in owning gold, one of the slides I don't have in here for brevity, but certainly is available on Gold Hub, which is our website. We've got a huge selection of data. Shows the volatility of gold compared to other asset classes. It's got this reputation as being a volatile asset, but if you look at the volatility of it, it is only as volatile or less volatile than equities, than emerging market assets, than commodities. The only thing that is much less volatile than gold are government bonds. So you are owning an asset class which has volatility, and therefore that's one way of measuring risk, but it's in line with most other asset classes apart from government bonds. Other than that, I don't really think that there are any specific risks that that I would identify with gold. I occasionally see stories about the potential for asteroids to be mined that contain gold and other precious metals, and that could crash the price of gold. But that seems outside the realms of any near-dated reality. We might be talking, well, my grandchildren might be talking about asteroid mining and its potential impact on metal supply. But for the time being, I think that's something we can dismiss for now.
Right, very good. As mentioned, we have in the audience today people from DB and DC schemes. How would you, should they go about investing in gold differently?
Well, and I think the one thing I can quite easily and safely say is every situation is different. Every portfolio, even one DB versus another DB, will be different in terms of optimal allocations to gold. One of the things that we have done for a number of clients, both in North America and in Europe, is to take an idealized portfolio from them and say, okay, in your particular case, we would recommend that you have this much gold. So that's an exercise that we can undertake on behalf of potential investors in gold. And generally speaking, the work that we've done on that has been able to demonstrate to them that they should have, first of all, they should have an exposure to gold. Almost every portfolio that I can think of has benefited over the last 5, 10, 20 years from having a gold allocation. And generally speaking, the more equity risk you're running, the higher the gold allocation should be. Right. But if anybody's interested, contact Jaspar, and we'd be, you don't have to show us everything you own. It could be hypothetical, it could be indicative, and we'd run through the argument and show how much gold would have worked in your portfolio.
Yeah, I mean, there was one other interesting factor that just came out of talking to Rachel yesterday for defined contribution schemes, which is that they don't know when that money is going to be called upon, because people can withdraw the money early, transfer, things like that. And what we see in a lot of pensions is they have assets that give them good returns over the long term, but aren't necessarily liquid. A good example of that might be real estate, which you hold it over a decent period of time, it works for you, but when you need that money, particularly in a liquidity event or in a difficult economy, it's difficult to get hold of that money. And so what we're trying to show you today is that not only are gold's returns on a par with the other things that people hold in their pensions, but there's this liquidity angle too, where you can convert it into sterling when you need to very quickly. So I think that's worth noting for pensions.
Right. Okay. Good stuff. Good stuff. Did you want to say something, John?
No, I didn't. I did see, looking at the Q&A, there was one in there that I'll address, and it's from Mr. Anonymous, or maybe Ms. Anonymous, I don't know. Have gold price fixing reputational issues from recent years been sorted out by the industry? And I'll talk in a slightly broader context from that. First of all, the fixing issues that hit the gold market have been directly addressed by replacing the traditional gold fixing with a independently run auction process to establish a benchmark price for gold each day. This is done under the auspices of the London Bullion Market Association, not by us, but by people we work reasonably closely with. So I think that the issues that are affecting the traditional gold fix, which was similar in a way to what was going on with LIBOR, appear to have been directly tackled. There are, I think, outstanding issues in the gold market, though. sort of changing gears and thinking less about the investment case for gold and looking more at the infrastructure and the policy side. The fact that about 2/3 of gold transactions take place in the over-the-counter market, which is quite opaque, is something which I think we would describe as unsatisfactory. One of the things that I like to do as a strategist is to look at data, to be able to demonstrate the liquidity is there, to be able to demonstrate the bid-ask spreads, etc., to see cleared trades, to have central counterparties. Things like that would, I think, be a great benefit to the gold market. At the moment, the OTC market looks a little bit of a relic from the past, from the last century maybe. And I know that there are efforts to modernize and to bring the gold market up to date. A much more transparent market, I think, would allow much better regulation and oversight by regulators of that market. So there are efforts that are taking place to move the gold market into the 21st century. I don't think it should stop people considering gold as an investment at the moment, but I think we'll be better able to demonstrate its investment merits if and when the gold market is brought into into the 21st century.
All right, well, thanks for that slightly tricky question. Moving on, central banks have been substantial purchasers of gold in recent years. Why are they doing that?
Well, the presentation that we give to central banks is not dissimilar to the one that I've given here, although it's usually not in sterling, as you can imagine. The idea of gold being a diversifier, particularly of US dollar assets, when you think of the majority of central bank assets are US dollar fixed income assets, then that's one argument. The fact that it is a strategic asset, which is nobody else's liability, is also very strong. And what I mean by that, we've seen some countries that have run into difficulties because they have offended the United States in one form or another and have been threatened with financial sanctions, have been threatened with their ability to use the dollar payment system to actually transact in dollars. The fact that when everything else is unavailable to you as a country, because you have happened to offend the superpower, the fact that you have gold which you can sell or indeed swap to raise liquidity, as many central banks have done from time to time, is seen as a good advantage. I think the other thing is as well, if you look on the longer term, there is a belief, certainly for people who think decades rather than quarters, that the US dollar won't be the reserve currency of the world indefinitely, not if you look at the speed and the size of the Chinese economy. Now, if you want to diversify away from the US dollar, you're left with certain choices. You need deep markets, very liquid, and where you're comfortable with credit risk. And historically, those have included sterling, the precursors to the euro, and now the euro, the Japanese yen, maybe the Swiss franc, and some of the other smaller currencies. Gold stands up well, particularly in the current environment where we have seen downgrades of debt, concerns about the coherence of the euro system, very large fiscal deficits and outstanding debt in Japan, etc. So on the basis that it's difficult to own Chinese assets at the moment, and even though central banks can own Chinese government debt, the market for those is not particularly liquid, particularly if you want to get out. I think gold has benefited a lot. So we've seen purchases from lots of central banks post-financial crisis. And I guess the other side of the coin is as well is that the central banks that own a lot of gold, developed market central banks who've owned it since the gold standard, have stopped selling because they recognize more so now than they did before the financial crisis that it's an asset that has unique qualities and that it's accepted by the IMF as part of your international reserves, and it's the only commodity that is, and that it's a good diversifier of other risks. So they've stopped selling. Emerging market central banks that don't have much gold have been buying. Would expect that to continue. They bought record quantities in 2018, 2019. Will buy less, we think, going forward. not least because of the impacts of the current crisis. But we expect, central banks to continue buying for the foreseeable future.
Right. So we're getting short on time, but one other question about central banks is obviously we're all hearing that central banks are printing lots and lots of money right now. And how, what is gold's role as a response to this?
Well, who knows where we end up as a consequence of the expansions of central bank balance sheets and the expansion of the stock of government debt. But one of the things that we did see in 2007, 8, 9, no, not 7, 2008, 9, 10, we saw large investment buying of gold in anticipation that the consequences of quantitative easing, particularly in the US, would lead to a loss of faith in the US dollar and potentially much higher inflation. Now that didn't materialize in the decade after the GFC, but I think investors who were concerned by what was happening in response to the global financial crisis will probably be terrified with what the consequences will be of the coronavirus crisis. So I would expect to see investors buying gold with enthusiasm as budget deficits rise, as the stock of debt increases. So, I mean, gold ultimately is an asset which is nobody else's liability, which is good. And it's also an asset that can't be, you can't print gold. You can't suddenly increase the stock of gold by the factor of 2 or 3 or 4 times like you can currency in circulation. So I can certainly see the attractions for people who do worry about these sorts of things.
So, well, thanks for that. I have time for one more question. And if it's okay with you, I'm going to send you some of the others and maybe you're happy to answer them and we'll send them round to the audience today afterwards. But just as a last question for today, how is the World Gold Council working with the UK's pensions community?
Well, this is a good example. We've partnered with the PLSA as an education partner. I think that's right, Jaspar. Do you want to talk a little bit about that?
Yeah, I mean, we see what gold can bring to portfolios, and we've looked, when we look at the UK pension space, we think there's a role for it to play there. And I think that, the poll earlier is a perfect, demonstration of the fact that it tends to be not recommended by consultants. I think there's a lot of misconceptions around gold's returns. And so we want to play a role really in educating pension funds and potentially increasing the holdings of gold within those funds because we think it's in their interests. There's other things we can do. So look, my email's at the end of the presentation. We've certainly been working with some asset owners to go through, a sort of a portfolio optimization process bespoke to them. I noticed in the webinar chat on the side, somebody's, I think it was Derek, who's posted around, what's the point in holding less than 4% gold? And I think what he means by that is, how will gold influence your overall number? Or your overall return number if you don't own more than 4%. And what we've done is taken broad holdings that clients have, run the numbers with different allocations of gold in there, and then demonstrated to clients what those portfolios would have returned had they included gold, and not only what they would have returned, but also how their risk-adjusted profile would have improved. So how the returns they're getting improve per unit of risk that they're taking. And those have been very interesting. We've seen clients add gold who didn't hold gold, and we've seen clients add a little bit more when they've realized that actually perhaps they own under that 4% threshold, for example. So, we've got a team now, myself, there's Claire Lincoln now, who's just joined us in London, and Nilesh, who both know the pension space. I say Nilesh knows it fairly well. And we are looking to get out and help where we can, educate, and ultimately, this doesn't cost you guys anything because we're not really selling anything at the end. It's just education that we do, and we do it on behalf of our members who are gold miners.
Right. Well, thanks very much, Jaspar and John. You've gotten through a lot of material today and answered lots of questions. I'm sure that everyone's learned something.